Good afternoon, everybody. This is Machida, in charge of the management of Japan Metropolitan Fund Investment Corporation. Today, I'll be presenting the financial results of JMF for the 47th fiscal period. Now, please look at page 2. This report outlines the growth strategy currently being implemented by JMF and the quantitative targets announced in the previous fiscal year. Again, as a quantitative target, we set the goal of increasing DONAV, or DPU divided by NAV, to 5% and continuously grow NAV. By achieving this target, we aim to raise investment unit prices to a level above NAV. Please take a look at page 3. I will now explain the progress of our quantitative targets. As actions to achieve the quantitative targets, we've set out to raise our portfolio NOI by 10% over the medium term, return sales gains by at least 300 yen per unit per fiscal year, and further improve earnings by replacing assets and utilizing LTV capacity. NOI increased from 29.2 billion yen in fiscal year 46 to 31.3 billion yen in fiscal year 49, 7% increase in a year and a half, and an annualized growth of 4.6% is significant improvement. We succeeded in making major progress toward NOI increase of 10%. Next, I'd like to discuss the return of sales gains. Since the previous announcement of financial results, we made a series of announcements. We succeeded in selling at a level significantly higher than the book value and appraisal value. We secured a large amount of sales gains that will be a source of a return of 300 yen per unit per fiscal period for 3 years, until the 53rd fiscal year ending August 2028. Finally, regarding external growth, we acquired a new office portfolio from Fujisoft at approximately 70 billion yen, with an NOI yield of 4.7% and an unrealized gain ratio of more than 30%, improving DPU through asset replacement. We'll make significant progress toward achieving our targets in both internal growth, return of profits from sales, and external growth. At the same time, we'll eliminate portfolio rent gap 10% for internal growth, actively replace assets to increase sales gains, continue with CRE carve-outs to achieve disciplined external growth. Please take a look at page 4. DPU for the 47th fiscal year rose 0.4% from the previous period to 2,820 yen, reaching record high. The 48th DPU is expected to hit record high of 2,952 yen. 49th will be 2,850 yen. The 49th fiscal period is down from the 48th. However, there is a bidding closed at last weekend, and if we properly execute this deal, we'll be back to the level. NAV per unit also hit a record high at the end of the 47th due to the increase in appraisal value associated with improvement in NOI, rising 2.2% from the previous period to 123,500 yen. This means CAGR of 5% over the past 2.5 years starting in the 42nd period, and a 48th due to the acquisition of an office portfolio with large unrealized gains from Fujisoft. NAV per unit is expected to rise further. The major point of today's announcement is that underlying EPU of the portfolio has improved significantly, calculated by excluding amortization of goodwill and sales gains from net income. Despite rising interest rates and the establishment of certain level of interest rate buffer, primarily due to the previously mentioned NOI improvement, the forecast is expected to increase by approximately 7% from 2,300 yen level in the 46th period to 2,500 in the 49th. Please see page 5. This section outlines the results of internal growth, the main driver of our growth strategy. The average annual growth of existing portfolio NOI over the past 2 years and next year is expected to be 3.2% over the total 3-year period, a further increase from 3% indicated in the previous period. This growth is supported by increase in the rent for urban retail facilities and offices, as well as in parking lot revenue, card fee revenue, and ancillary income, such as new signage. The portfolio rent gap still exists at 10%. Market rents continue to rise, and additional income such as parking lot revenue is expected to increase in the future. Price hike in general may increase percentage lease revenue. We will continue to achieve internal growth that exceeds expectations of investors. Please see page 6. I will explain the progress of return of profit from sales. In third asset sales announced so far, we expect to generate approximately 15.8 billion yen in gain from 47th to 49th. About 3.3 billion yen of this is returned in the 47th, and the portion is transferred to the reserve for reduction. A total of 14.6 billion yen including the reserve will be returned by the 53rd, ending August 2028. Of course, we will continue to sell assets, so we will continue to strive to obtain capital for return and improve DPU over medium term. Please see page 7. I will explain external growth. In the 47th fiscal period, we were able to sell at high prices and buy at low prices, which is the principle of external growth. With regard to asset sales, we successfully sold properties of the significant unrealistic losses at prices higher than book value, transferred assets with limited growth potential and risk of rental decline, exceeding their appraisal value at nearly double the appraisal value and book values. Regarding acquisition, a relatively new office portfolio from Fujisoft has been acquired at higher than implied cap rate and an unrealized profit margin of more than 30%. Going forward, with regard to asset sales, since we focus on sales activities in fiscal period 47th, we are currently considering sales of approximately 10 billion yen. One of the assets closed bidding the last weekend. We should be able to sell above the appraisal value. Going forward, we plan to sell about 40 billion yen of assets. We are receiving unexpectedly high offers even for assets not currently designated for sale. We'll continue to make use of these offers to sell them at high prices and return the capital gains. Next, I'd like to discuss asset acquisition with preferential negotiation rights, or a high likelihood of acquisition amounts to approximately 30 billion yen. These are balanced with office retail and residential, and the NOI yield exceeds the implied cap rate. In addition, although I cannot give specific details, there are several CRE carve-out deals in consideration after Fujisoft. We will build a pipeline with discipline as a new initiative. We will consider not only income returns, but also capital returns as well. We aim to establish a framework that enables stable dividend payouts from capital gains, not only by utilizing unrealistic gains from existing properties, but also by obtaining capital returns from new investments, such as value-up projects in retail properties. Some of the assets acquired from Fujisoft are located in areas suitable for residential. We may sell them to condominium developers after tenants leave. This is an investment for capital returns. Investment capacity is maintained sufficiently through future asset sales and LTV capacity. Also, due to an increase in cash flow and appraisal value, LTV will continue to decline, and investment capacity will increase further. Since we have sufficient investment capacity, we will consider capital increase when we have an assurance that such a capital increase will have a positive impact on investment unit price. Not to mention DPU and NAV will have to improve. Please see page 8. Generally speaking, diversified REITs tend to be undervalued by the market compared to the specialized REITs. So-called conglomerate discounts exist. There are several possible reasons for conglomerate discounts. Presence of underappreciated sector-based expertise may not be as good, or from the investor's standpoint, the difficulty in conducting valuation assessment. On the other hand, we believe there is a premium for diversified REITs. JMF is a merger of retail REIT and office REIT with specialized expertise, and KJRM as a whole manages REITs and private placement funds with high expertise across sectors. In particular, the combination of retail and office is compatible and easy to generate synergies. With its high retail expertise, JMF is in a position to maximize its effectiveness. For example, during COVID-19 pandemic, both office and retail were weak. But service tenants such as beauty clinics had momentum. We used our retail tenant relations in office buildings and invited service tenants to realize upside. Recently, as office rents are surging, we are inviting office tenants to the upper floors of the Omotesando area and establishing set-up offices for further upside. In terms of external growth, we have a wide range of investment targets. We can replace assets rather quickly, respond to bulk deals and multi-purpose applications, and new applications as well. In addition, we may invest in anticipation of the sector cycle. JMF has acquired high street assets at low cost during the pandemic. We made major acquisitions before housing rents and office rents began to rise. If we operate properly, diversified REITs may achieve a kind of growth that cannot be imitated by specialized REITs and will operate towards a diversification premium. In addition, we will evolve our disclosure to make it easier for investors to value. We'd appreciate it if we could have discussions at one-on-ones and other events. Next, I would like to explain the points of the financial results for the 47th and also the forecast for the 48th using pages 9, 10, and 11. First of all, for the 47th fiscal year, operating revenue, income, and net income all exceeded the guidance announced on April 21, 2025, with EPU closing at 3,016 yen, up 11.9%, and EPU closing at 2,820 yen, up 1.8%. Despite a decrease in revenue due to additional sales, NOI was able to significantly increase mainly in complex urban retail and office sectors, and both revenue and net income. Next is our 48th fiscal period forecast. Operating revenues, operating income, and income all significantly exceeded the forecast for April 21, 2025. EPU is projected to increase by 16.8% to 3,242 yen, and DPU up by 3.6% to 2,952 yen. Primary factors are the recognition of additional gains on sale of properties and external growth driven by the acquisition of office portfolio from Fujisoft. This is expected to generate revenue significantly exceeding the drop in revenue from the sale of additional properties. For existing properties, we plan to implement strategic investments such as implementing additional sales promotion initiatives to boost sales in retail facilities and advancing restoration work, with the aim of enhancing future earnings. Excluding strategic investment costs, the existing portfolio is excluded. We are expected to see steady revenue growth, primarily driven by cumulative contribution from rent rises and lease-ups for mixed-use and office properties, as well as rent increases for residential properties. Furthermore, while we continue to anticipate a certain degree of rate hike based on the current environment, non-operating income and expenses are expected to improve as a result of refinancing completed to date. For the first time, we are announcing a forecast for the 49th fiscal period. We project EPU to drop by 7.8% period-on-period to 2,990 yen, and DPU to drop by 3.5% period-on-period to 2,850 yen. While operating revenue, profit, and income for the period are all projected to fall below the 48th fiscal period forecast, this is primarily due to differences in gain on sales, and NOI and underlying EPU are steadily increasing. Although revenue declined due to the expensing of fixed asset taxes on properties acquired in the previous period and the impact of property dispositions, the increase in revenue from existing properties has more than offset these losses. This was also driven by the effects of the strategic investments explained earlier for the 48th fiscal period. We anticipate robust growth, particularly in mixed-use and retail facilities. Regarding the existing borrowing costs, refinancing in 49 fiscal period incorporates a 40 basis point upward buffer from current interest rates, leading to an expected increase over the previous period. However, if the rate hike remains within the buffer, the impact will shift to an upside. Furthermore, as previously stated, if the disposition for which bidding closed last weekend is successfully executed, we plan to raise DPU to the same level as of 48 period. This concludes the financial results for the 47th fiscal period and the forecast for the 48th and 49th fiscal period. Moving on, I would like to highlight the main points starting from page 13 and onwards. Please refer to page 14. Regarding internal growth, I will first explain the characteristics of JMF's portfolio. All segments, including retail, office, and residential, feature rent gaps and upside potential. The retail segment is centering on short-term and fixed-term lease contracts primarily in urban commercial centers, where revenue-based rents are achievable. The office segment has a rent gap exceeding 10%, while residential segment is located in densely populated urban areas, with nearly 5% rent gaps. Page 15. I will explain specific results of the internal growth initiatives. This period's lease renewals saw robust rent rise across all sectors, achieving portfolio rent increase rate of 7.7% and DPU impact of 32 yen per fiscal period. Notably, the increase rate for hotel and retail properties significantly increased, exceeding 10%. In addition, the proportion of rent increases among lease renewals exceeded 50% across all sectors, with residential properties achieving increase in nearly all cases, reaching 78%. Please take a look at page 16. First, regarding retail properties, rents in existing portfolios are growing at an average annual rate of approximately 3%. This high growth rate is driven by rising market rents and nearly zero vacancy. Please refer to page 17. First, regarding sales trend during the 47th fiscal period, sales performed well in all areas near major railway stations and residential districts, driven by renewal and inflation. Meanwhile, high street sales temporarily declined due to the impact of the Hong Kong originating prophecy, but gradually recovered from August onward and now have returned to the same level of the previous year. This year, revenue-based rent rose in the 47th fiscal period, driven by terminal station areas and residential neighborhoods. From the 48th fiscal period onwards, the recovery in high street sales added to this. An existing portfolio is growing at the pace of 3%. With revenue-based rates set for 60% of retail tenants, we can expect further rise in revenue-based rent as sales continue to expand. Kindly take a look at page 18. Specific examples are listed. At Mozo Wonder City, the large-scale renewal carried out this spring has led to sales growth and increased revenue-based rents. Combined with cost reductions achieved through bidding process for property management and building maintenance companies, the appraisal value rose 6.2% this period. At Cute Harajuku, proactive rent adjustment and tenant replacement capitalizing on increased commercial demand along Takeshita Street achieved rent uplift of over 20%. We're actively pursuing NOI improvement for master leased properties as well. At Aeon Naha Shopping Center, by collecting usage fees from tenants corresponding to CapEx investments, it is expected to yield 13.2% NOI increase. To achieve a rent increase even in master leased properties is also the strength of JMF. Turning to page 19, next, regarding offices, we continue to achieve robust rent growth, capitalizing on active leasing market and delivering steady results. At JMF Building Sakai 01 acquired last year, rent increases were achieved by multiple tenants either through contract renewals or before the expiration of ordinary lease contracts. This resulted in increase in appraised value close to 2% within only 8 months of acquisition. At JMF Building Ueno 01, where the main tenant is scheduled to vacate during the 48th fiscal period, backfilling is already in progress, with leases being signed at higher rent levels than those of the previous tenant. Cost reduction efforts have also progressed, leading to 6.9% increase in the appraisal value for the current period. Regarding 2 Twin 21, at the time of the previous results announcement, approximately 2,500 tsubo of vacancy had emerged in the MID tower, but the backfilling is now nearest complete, accompanied by rent increases. Please refer to page 20. Regarding residential properties, rent increases continued with high growth rate of 7.3% on tenant replacement and 2.6% at the time of rent renewal. Rent uplift is particularly strong in Tokyo Metropolitan area. Additionally, dividend yield significantly improved to over 8%, driven by strong rent increases in private REIT investments and gain from asset replacement. Also, for hotels, of OMO 3 and Tokyo Akasaka, which operates under a fixed plus revenue-based rent structure, has seen a significant increase in variable rent, more than doubling compared to the 43rd period, 1 year after its opening. Kindly refer to page 21. In addition to rent increases, we are pursuing a number of initiatives to enhance NOI, such as car and bicycle parking revenue, signage billboard revenue, card processing fee, and other ancillary income sources. By steadily accumulating these improvements across individual properties, we anticipate NOI impact of approximately 110 million yen per fiscal period. These efforts are contributing to robust NOI growth. We have also included examples of integrated premium realization through internal growth, as mentioned earlier. By strategically replacing tenants, transitioning from office to retail and vice versa, we have achieved significant upside potential. Please refer to pages 23 to 26. This section outlines our achievements in external growth and asset replacement. While we will omit specific details, let me explain the outline of the sale and lease agreement from the CRE carve-out deal with Fujisoft. On page 25, the agreement with Fujisoft incorporates a rent revision clause that allows rent adjustment every 3 years based on the change in prevailing office market rates. This office market rent adopts the market rent for each property's location area as published by multiple office brokers. Data shows that during periods of inflation, the rate of increase in office market rents tend to exceed that of CPI. The rental structure enables robust income growth fueled by inflation. Reviewing the past trend over the past year, rents in office market where this property portfolio is located have risen by approximately 4%, demonstrating that significant rent increase can be expected at the time of lease contract renewal. Please take a look at page 28. We will now discuss finance and sustainability. Regarding financing, considering the current funding environment, we will implement a fixed-rate borrowing as a core of our funding strategy. We executed financing focusing on medium-term fixed-rate borrowing, resulting in a fixed-rate ratio of 93% and a long-term debt ratio to be 96.9% for the 47th period. Furthermore, the 48th and 49th fiscal periods, refinancing will primarily be conducted at the long-term fixed rate, considering the possibility of interest rate hikes over the next 2 periods, a buffer of 20 basis points for the 48th period and 40 basis points for the 49th period. Regarding sustainability, we achieved the highest external recognition by earning the highest rating of 5 stars in the GRESB Real Estate Assessment for 5 years in a row. Finally, I would like to talk about our strategy. As strategies across J-REITs continue to converge, to achieve higher unit price, we believe the key going forward lies in how J-REITs can differentiate themselves and achieve higher growth. JMF possesses the largest asset base among diversified REITs, providing the strength to engage in aggressive rent negotiations without concern over potential vacancy risks at individual properties. Our main asset, primarily urban retail facilities, have 5 to 6 year lease contracts. Lease renewal for tenants who signed fixed-term leases during COVID-19 pandemic will peak between 26 and 28. We see significant upside potential in rent revision, and we will negotiate aggressively. Furthermore, JMF leverages cross-sector asset management to attract tenants in the most rent-generating use category at any given time. This enables us to achieve high NOI growth unattainable by specialized REITs, thereby creating clear competitive differentiation. KJRM, the asset manager of JMF, possesses advanced asset management capabilities that do beyond those of typical J-REIT operators. This includes over 20 years of retail facility operation experience and expertise in opportunity fund operations. As demonstrated by its track record with JMF and IIF, KJRM leverages a broad network of relationships from operating companies to international funds to excel in maximizing property sale values. Furthermore, leveraging the strength of its sponsor, KKR, JMF continues to achieve external growth through CRE carve-out deals, an area that is difficult for competitors to replicate. By leveraging these strengths, we will strive for steady income growth and sustainably enhancing unit price performance, with the ultimate goal of maximizing total returns for our investors. That concludes my presentation. We will be receiving questions. There is a raise hand function located at the bottom of the screen. For those of you who would like to raise questions, please tap the raise hand button located at the bottom of the screen. If you are participating over the phone, please press asterisks and 9. We will process the questions in an orderly manner. We will be sending a request to unmute you, and please unmute yourself when it's your turn. Please identify yourself, mention your organization name and your name. Those of you who are participating over the phone, please press asterisks and 6. Also, if you would like to cancel your question, please lower your hand. Once again, if you are joining over the phone, please press asterisks and 9 again. If you ask question during the answer, you cannot talk. Therefore, if you have multiple questions, please mention the question collectively. If you would like to ask another question, please press the raise hand button and wait. Yes. From SMBC, Nikko Securities, Tori-san, please.
This is Tori speaking from SMBC, Nikko Securities. I have 3 questions. First of all, about asset acquisition. So there is a possibility of major acquisitions. And this time, there was a number of assets acquired from Fujisoft. And also, as you mentioned, there are high probability ones, 30 billion yen, with the first rights. And also, there are several carve-out deals that may possibly happen. And for these deals in a current transaction market, there may be some assets already available in the market. So is that the case? Do you have a special source of information that is only available to KKR Group? So including the acquisition power or the capabilities, can you elaborate on the acquisition situation? And then also the second question is about sales. So there is 10 billion yen and then 50 billion yen in total possibly. And then so how would you characterize these assets that you are looking into selling? And in page number 23, I see these are the suburban retail shopping centers and revenues now maximized. So there are not many upside anymore. Or if you look into the suburban shopping centers where the revenue may decline going forward, and also in urban facilities, there may be some facilities where we can't really expect upside. So if you can discuss about how you decide on which assets to sell. And then the third question is, I think that for you, you are strong with urban assets and you have the power to increase the rents. And then especially for the retail facilities or the assets in urban areas, I do look at the data myself. But recently the market, I wonder if the rents are still strong or if we have come to a pretty good level. And also if market-wise, if it's still difficult to increase, then if there are any individual circumstances. So if we can discuss about urban facilities as well.
Thank you very much, Mr. Tori-san. So, number 1, regarding asset acquisition. Well, let me briefly explain about transaction market. So now, it's not only about us, but I know it's increasing in general, and especially for the urban assets. Everybody's expecting higher NOIs. And in retail locations like Ginza, 1% level, and in Shirogane or Takanawa, in residential areas, we are around a 1% level, so that's the kind of yield. And our market is quite tight at the moment. So at this kind of yield, well, we cannot really acquire, so we have to utilize our own network and use KKR information source or looking at the carve-out deals. And then, the pipeline we have built so far, we have been using our own network and KKR-sponsored carve-outs. And second question about asset to sell, how we pick out the assets to sell. Tori-san, I think you explained well. Number 1, We focus on suburban retail facilities where upside may not be expected going forward. And also in office, when a tenant leaves, then we have to decide if it's better to try the backfill or get the sales gains instead by selling to residential developers. So we are assessing individual property during the evaluation process, trying to seek the right balance. And then for the urban facilities, sometimes we do get very high offers. So for the investment unit price, sometimes it's better to seek the sales gains by selling at the higher prices. And then about urban facilities market in general, as I said at the beginning, the momentum of the market is strong. And so we're trying to see if we can get the sales gains. And I can't really say exactly where in Ginza, but there's 400,000 yen that's been offered for the multiple floors. And also in Omotesando, Tsubo price is nearly 400,000 yen for the mezzanine types. So the market is pretty good. And then the market rate always follows. And then also the luxury brands, we can't really take the data on their rates. So we basically have to follow. But market-wise, it's been quite strong. And in these strong market circumstances, we have to identify the strong tenants and then ask for the higher rents. And that's actually our strength. So with this, we are aiming at achieving higher than market NOI improvement. Thank you, Mr. Tori-san. Next, from Mizuho Securities, Mr. Ohata-san, please.
My name is Ohata of Mizuho Securities. I have one question. Page 3, an executive summary of the internal growth on the left-hand side, NOI growth of 10% on midterm basis that is mentioned on this page. According to the presentation made previously, taking 3 years' time or 4 years' time, you are trying to achieve that level. Are you making advancement in your plan?
The timing of achieving 10% over a 3 to 4 year period, I mentioned that the urban type retail sectors. Between 2026 and 2028, there will be a lease contract renewal coming for those who signed the lease contracts at that time. And they grew quite solidly, so we were able to make advancement and we can achieve that level, rather than waiting for another 3 years. Thank you very much, Mr. Ohata-san. From Morgan Stanley MUFJ Securities, Sato-san, please.
This is Sato from Morgan Stanley MUFJ Securities, and I have one question myself, and it's also about page number 3 on the right side of the page, and this is about debt capacity and pipelines, unrealized gains, and then there's capacity to LTV 40%, and then including the book value of the asset to sell. I think the pipelines acquisition is pretty realistic and feasible. And when the valuation is increasing, I wonder if there is any PO that could be considered, or how do you assess it?
Thank you. So actually, I touched upon this during my presentation, and now our JMF unit price has increased in the past 6 months, and that was because of the internal growth and returning the sales gains. And here, if we are to turn to the external growth, then we may compromise the expectations we have cultivated. So for the external growth, we are to ensure that such strategy is going to be incorporated into the increase in the investment price increase. And so we are not thinking about this now, but we do have the acquisition capacity now. So we'd like to show the market what we can, and then once we're able to incorporate the external growth opportunity into our pricing, our share price, then we'd like to make a decision possibly. Thank you, Sato-san. So I would like to explain how you can ask questions. Those of you who have questions, please use the raise hand feature. And we accept questions over the phone, so please click the raising hand button. And if you are participating over the phone, please push *9. And we will be sending a request to unmute you, and please unmute yourself and identify yourself and the name of your organization and your name. If you're participating over the phone, please push *6 if you are appointed. If you want to cancel your question, please lower your hand. Those of you over the phone, please push *9 to cancel. You cannot talk during the answer. Therefore, if you have multiple questions, please mention your questions collectively. Let me introduce the questioner, Mr. Namiki of Okasan Securities.
My name is Namiki of Okasan Securities. Can you hear me? Thank you very much for your support on a day-to-day basis. The first question is about page 7, the lower part, income return growth plus a capital return. In the case of Fujisoft, I imagine this. When you are aiming at a capital return, I think you may be selling or disposing the asset in the short term rather than holding the asset for a long period of time. In this case, how are you thinking of the property? Is it because you would like to develop that as a residential condominium sector? And my second question is page 15, for the residential sector. Almost all contract renewals achieved rent increases reaching 78%. Surely market rents are going and the residential rent is going up as accordingly. That is what I imagine. I would like to know the backdrop of this high ratio of rent increases. These are the two questions I would like to ask.
Mr. Namiki, thank you very much for your question. First of all, about the investment aiming at capital return. We consider both short-term and mid-term, and in the case of a mid-term plan, just like the deal with Fujisoft, upon a tenant moving out of the property, we may be able to dispose of the asset and get capital return. In some cases, this could occur within 1 to 3 year horizon. And noted in our presentation material, for example, if retail tenant wants to exit the property, we may proceed with a sale to capture capital returns. That may be planned on a mid-term basis, but we also retain the flexibility to hold the asset depending on market conditions and whether there is sizable unrealized gains to be captured. And next, about the residential sector, the proportion of those whose rent rise is very high in proportion. Compared with other peers, the level of rise in the rent is very high, and we are putting a lot of energy behind the negotiation to raise the rent. Through our experience in managing office properties, we have successfully achieved higher rents, even under traditional lease structures. This expertise is now being applied to the residential sector, where we are proactively learning and implementing rent optimization strategies with 80% of lease renewals yielding rent uplifts. This approach represents a key component of our strategic premium initiatives. Thank you. Are there any other questions? It seems there are no more questions, so we'd like to now close our Q&A session. With this, we'd like to close today's meeting for the 47th fiscal period, ended August 2025 for the Japan Metropolitan Fund earnings meeting for the analysts. And thank you very much for your participation in spite of your busy schedule.